Weekly income sounds incredible. Imagine an ETF that sends cash to your account every single week. That's the promise behind WPAY, WPAY. But weekly payouts raise an important question most investors never stop to ask. Is this real income or just your own money coming back over time? In this video, we're putting WPAY through a full all-in backtest. No hype, no marketing, real numbers. We're going to look at price behavior, distributions, reinvestment scenarios, and total return to see what actually happens if an investor goes all in on weekly income. So stay tuned. Welcome back to Simply Money. Today we're jumping into WPAY. But before we jump into the numbers, let's quickly talk about what WPAY actually is. Because a lot of investors see the weekly payouts and they assume it's just a dividend fund. But it's a little different than that. WPAY is designed to generate frequent income distributions, paying investors every week instead of monthly or quarterly. But that income doesn't come from traditional dividends like you'd see from companies in something like SCHD or an S&P 500 index fund. Instead, WPAY primarily generates income using option strategies. It's tied to underlying equities. In simple terms, the fund is using financial contracts to produce cash flow that can then be distributed to investors on a weekly schedule. That means the distributions investors receive can come from several sources: options income, stock dividends, capital gains, and sometimes return of capital, depending on market conditions. When you see a fund paying very frequent income, it doesn't automatically tell you how the strategy is performing. That's why we run these backtests, because the real story isn't just how often a fund pays. It's what happens to your total portfolio value, your income stream, and your long-term returns once those distributions start flowing. Now that we understand what WPAY is designed to do, let's run the numbers and see what actually happens when an investor goes all in on the strategy. Now, to be clear, this is not financial advice. This is for informational and educational purposes only. I do not recommend you go all in on WPAY or any fund for that matter, but you're going to have to make your own decisions and know that all investments come with risk. So let's jump into the worksheet. All right, for those that are new to the channel, thank you for joining us. Welcome back to our subscribers and those who watch videos all the time. I appreciate your support. What we do on this sheet is we take an inception date of the fund, and we have here WPAY on September 17th, 2025. Right here we show the price at the inception. We're right close to it. And this is a weekly paying fund. On these all-in scenarios, we take our income portion of our portfolio, and we decided to say, what if we had gone all in? Keyword there is what if. We did not, and we will not, on this fund or any fund, go all in. But what if we did? What would have happened? Well, we would have bought 9,822 shares at that time. What we're going to do is we're going to look at what would happen if we had done that, and then we reinvested all the dividends, or we do 50-50, or we don't reinvest any of them. How did the fund perform? What kind of income stream are we getting? How is it performing over this time frame? This is a short time frame. It's not been around long. It's a very new fund, so we only have a couple months to look at, and we're going to run down those real quick. Now let's start with the share price. Like I said, it started at $53.45. As we come down, you can see that it has gone through some different downturns and then gone back up a little bit, but mostly it has been declining. So this is one that it's paying out frequently. It's paying out at a high rate, but it is creating a NAV erosion in that, and we have to watch that. So will it ever recover? We don't know. But in this time frame, it is down, share price, negative 31%. That is something to be watching and to be cautious about. Now, if it had dipped and then come back up, I would be okay with that if it was following the trend of the market as a whole. But if you look from September till February, the market overall has done pretty well. I mean, it's had some ups and downs, obviously, but it's not been in a bear market. We haven't been in a recession. We haven't been in some major pullback. and it's never gone forward. So it is doing what a lot of these funds do, and it is kind of chipping away at your NAV. So we have to watch that. Now, what else we want to look at is what the distribution's been doing. Now, the distribution yield has been about the same. It stays consistent. So as the price drops, the amount that it pays drops, but the yield stays about the same. We can see some of these distributions have been fluctuated in the beginning here. A lot of people were super excited here at the beginning with 51 cents and 88, 73, 85, 73, but then dropped down to 52, got down here to 39. And as we come down, you can see we dipped into the 25. And the latest one that I have here at the recording is we're looking at 27 cents. So obviously, as the prices come down, that distribution has come down as well. It has averaged 46 cents, but it is declining. The trajectory on both the price and the dividend distribution has been down. We also want to look, so here we're going to look at column D, the full drip. This is we take the distribution and we reinvest it and buy more shares. With that, we want to see that growing. We want to see that dividend growing, because even though we're not taking it, we're buying more shares. And as the price is coming down, the dividend's coming down, that distribution, we're wanting it to grow because we're getting more and more shares. And we're not seeing that with this. As you look, you can see that we added quite a few shares because each week we're getting this distribution and we're buying more shares. We had 5,000, 8,700, 7,400, 8,700. But as we come down, now we're only getting 4,000, 3,100. So the distribution has, even with full drip, has been declining pretty rapidly in the short time frame and paid out $123,000 in distributions. We were able to buy 2,564 more shares. But look at this, our share value, our portfolio value is down almost $73,000. That's a total return of negative almost 14%. That's not good. When your total return with full drip is negative, that's something to be cautious about. A lot of times people will be okay if this NAV is dropping, if the share price is dropping, if the distribution is keeping up with it and it's able to, especially with a full drip, make this increase. Now we're going to look at this and see what some of these other scenarios do, because sometimes taking the distribution and reinvesting it somewhere else, you actually get a better return. But if those that are peaking over there, you can see that is not the case. The 50% drip, same thing. We're taking half of the amount, and we're buying more shares, and then we take half the amount. So this reflects half of the amount, so we get it twice, and we're buying more shares with one half, and we're taking half as distribution for income. Again, you can see we were at 25, 4,300, 3,600, 4,300, and now we're looking at 1,500, 1,400, and again, that's half. So here you'd be looking at 3,000, 2,800, 2,800, but up here you're looking at 8,000, 8,000. And so again, it has been dropping. We did add 1,200 more shares. We were able to get $58,000 of income, but our portfolio is down $122,000. Just the portfolio balance is down 23%. We'll look at that total return here in a minute. But now I want to go to the zero drip. Here we're just taking the distribution. And this is what a lot of people buy these funds for. They put money in, some capital in, and then they're just taking the income out. Over the course of this time frame, you can see that your distribution has dropped rapidly. Now you're only getting about $2,500. So in the course of these few months, you've received $110,000, but your portfolio has dropped $166,000. Your portfolio has dropped more than your income that you're receiving. So you're not making money on this at this point. Again, this is short term. We don't know if long term this is going to rebound at all, but I would be very cautious with that. And I'll give you this as a warning. This is just my opinion. I'd be very cautious with WPAY because even with the distributions, you're not keeping up with the NAV decline. And we need to watch that to see if it rebounds or not. But I would be very cautious at this point. With no drip, you're down negative 31%. So let's look at total return. With the full drip, you're down negative $72,000 because everything you received, you put back in. That's what it is. You're down negative 14%. With the half drip, you receive $58,000, but your portfolio unrealized gain is $122,000 down. So that's a loss of $64,000 or negative 12%. So as you can see, you're actually doing better by taking some of the cash. And then with the no drip, you actually did even better with negative 10%, but you're still negative. The zero drip, you received 110 in cash, 110,000, but you're down 166,000. That's a total loss of 55, almost 56,000, or that negative 10%. That is WPAY's full drip, no drip, or half drip scenarios. And you can see taking the cash actually did better. We don't know long term. If we come back in a year, if this price rebounds some, then obviously this full drip is going to do much better because you've added so many more shares. We'll keep monitoring that, and we'll do another video on this down the road. Over here, we'd want to do what we do. Sometimes we have our calculator where you can choose what percent you'd want to reinvest and what percent you'd want to keep. With that, you'd want to, sometimes people say, well, I want to take out all I can, but try to maintain my balance. Well, with this, there's no scenario that works. So we just put in the 30%, shows you how much income you could get. And doing that, you'd receive $80,000 of income, but you're down $140,000 in balance. I wouldn't be real pleased with that. I'd be actually very concerned with that, even with $50,000, but let alone $525,000. Over here in this calculator, you can put in an amount you want to keep out, and then you keep that amount, and whatever is left gets reinvested. You can see this first month there wasn't first week there wasn't a distribution, so you took the $3,000, but you're down negative $3 because you had to sell some shares to get that cash. And as you come down, you can see that the amount you're reinvesting is getting smaller and smaller. Now you can change these yellow cells here. We could put 2,000, whatever you want in there. Same with this percentage here. You can also change what amount you put in that you invested and when you invested. So perhaps you didn't invest until October or November. You can put that in here and the amount that you invested. If you like this sheet or all the sheets that I use, you can get that in the link in the description below at Buy Me a Coffee. All our sheets are available there. This is the WPAY drip. It's available for you to get and play around with these numbers. But as you can see, there's no good scenario so far. Again, only about 5 months of data that we have here, but these 5 months have not been good for WPAY. What are your thoughts? Do you own WPAY? Let me know down below. Those that follow the channel, you've seen my personal portfolio, the income portion, and what I have there. And I do have a small portion of WPAY that we were looking at, and we're just at this point reinvesting the distributions into other funds like SCHG and some other funds that we're doing. So we're taking that full drip and we're just reinvesting it. And that's what we're doing with it. It's not obviously the full portfolio like this. It's just a small amount that we have in there that we're dripping into other funds for the time being. We'll keep you posted on that. Check out those videos on the playlist, our portfolio overview on what we share with those each month. So that is WPAY. I appreciate you joining me. If you like these videos, don't forget to hit the like and subscribe button, and we'll see you next time on Simply Money.